Is venture capital the same as private equity? We answer that and more in this video, which is a part of a series from my book, How to Sell Your Business to Private Equity. My name is Nick McLean. I've been with 4 Pillars Investors for its eternity. I'm one of the co-founders. Been in private equity and mergers and acquisitions for almost 20 years. And what I've learned throughout that 20 years is that there's a right way to market your business to private equity and many wrong ways. Today, we just want to educate the viewers a little bit more on what to expect whenever you're trying to sell your business to private equity, the differences among the different types of buyers, and how you can position your company as strongly as possible in order to get the most interest and thus the highest valuation or simply the best partner for you. In short, no. While venture capital does buy the equity of private companies, the companies in which VC invests are in an early stage, i.e. they're startups. PE invests in mature businesses with positive cash flows. If you want to avoid sounding unknowledgeable, understand the difference between VC and PE and do not use the terms interchangeably. To learn more, check out my video that delves deeper into VC and PE and how they are similar and how they are different. Despite economic uncertainties, M&A activity remains robust globally in all segments of the market. However, remember that regional differences play a role. While North America and Europe maintain their lead, emerging markets in Asia and Latin America are attracting growing interest. The same holds true across industries, as different industries exhibit different M&A trends. Through it all, the single most important macroeconomic factor impacting M&A is interest rates. So don't overlook the power of economic policy in shaping your exit. The global M&A landscape is sensitive to external factors. Stay informed about potential headwinds like trade wars, political instability, or economic downturns, and assess their impact on your targeted segment and exit timeline. Evolving regulations, especially around antitrust and data privacy, can influence M&A activity in certain specific sectors as well. Ensure your business's compliance to avoid potential deal delays or disruptions. If you're reading this book, you probably fall within one of 3 size categories: SMB, LMM, or MM. Let's take a look at what those 3 categories are and, quite frankly, what those letters mean. These might also be called Main Street deals or talked about in conjunction with the term entrepreneurship through acquisition or even search fund deals. Typically, these deals have earnings of less than $1.5 million. Additionally, the purchase price and the structure are typically such that a Small Business Administration (SBA) loan can be used for the majority of the cash needed to close the deal. The SBA loan max is $5 million, though some lenders can do what they call a pari passu loan, which is a conventional loan alongside an SBA loan that is pari passu or on equal footing to the SBA loan. The earnings metric that SBA loans commonly use is Seller Discretionary Earnings, SDE. Transactions of this size are often referred to as buying a job, and SDE represents how much the new owner could, in theory, pay him or herself. Additionally, in some SMB deals, not all, working capital will not be included in the purchase price, but instead will be incremental to the purchase price. So the purchase price might be calculated as a multiple of SDE, perhaps 3x, and then the value of the inventory and the accounts receivable will be added to that, and that of the accounts payable will be deducted. Or sometimes the seller will retain ownership of the AR and AP and just sell the inventory. There would be more discussion on working capital later in this guide. I'm sure a Google search might return different results, but I would consider an LMM deal to have revenue between 20 and 250 million, or earnings before interest, taxes, depreciation, and amortization, or EBITDA, of 2 million to 20 million. If you're paying attention, you might notice that there is an earnings gap of $500,000 between the largest SMB deal and the smallest LMM deal. The reason for this is that deals with EBITDA of 1.5 million to 2 million are in kind of a dead zone. Typically, they are too big to use an SBA loan for, but too small for most private equity funds or financial buyers. Lower middle market deals are almost always reflected as a multiple of EBITDA, not SDE. Some decry the use of EBITDA, most notably the late Charlie Munger.
Charlie?
Yeah, I think you would understand any presentation using the word EBITDA. If every time you saw that word, You just substituted the phrase bullshit earnings.
But EBITDA is far better than using net income, acknowledging, however, that it is not the greatest proxy for cash flow, not even a good one actually. Working capital is also treated differently in a lower middle market deal. Working capital is included in the purchase price, and the amount included will be based on historical levels. The period of time used, 3, 6, or 12 months possibly, will depend on a variety of factors such as seasonality, growth, and others. The takeaway here is that the buyer will only pay X dollars for your business if adequate working capital remains in the business. Here's how a buyer might determine how much working capital they expect to remain in the business. The buyer and the seller determine what current assets and current liabilities will be conveyed to the buyer. End-of-month balances for those accounts will be tabulated. The sum of current liabilities for each month will be deducted from the sum of current assets for each month. Those results will then be averaged to calculate the working capital peg. Shown here is a table listing hypothetical values for various current assets and current liabilities. For example, you can see in month 1 through month 6, the AR balance ranges from $850 on the low side to $1.1 million on the high side. Similarly, there's some variation for inventory as well as AP and accrued expenses. To calculate the net working capital peg, find the average for the months used. Based on the numbers in the table, the working capital peg would be $3,350 divided by 6 equals $583.33. How did I get that? Well, you look at month 1, you have $1,250 in total current assets, you have $675 in total current liabilities. The net working capital for month 1 is $575. As you go across month 1 through month 6, you can see that the total for net working capital is $3,350. However, again, that's a total for 6 months, so you would divide it by 6. Now, typically I see 12 months as opposed to 6 months, but just use 6 months here for brevity. At a certain time period after the close, perhaps 90 days, the actual amount of working capital conveyed on the day of closing will be determined. The exact amount cannot, of course, be known because, for example, bills might be received after the closing. However, if the actual amount of working capital conveyed is greater than the peg, the buyer will owe the seller the difference. The reverse is true if the actual amount is less than the peg. Middle market deals are those with revenues of $250 million to $1 billion. Because these organizations are so much larger, middle market deals have a much higher level of sophistication. There is likely a whole deal team involved at the selling company, whereas in a lower middle market or SMB deal, typically the only point of contact is the primary owner. Potential buyers for your business come in a handful of different types. The two most prevalent are strategic buyers and financial buyers. Other options are an employee stock ownership plan, or ESOP, a management buyout, or MBO, or perhaps a special purpose acquisition company, SPAC, or even an initial public offering, IPO, if your company is large enough. Strategic buyers. A strategic buyer is one who has a strategic interest in buying your business. It might be a competitor, horizontal integration, a supplier, downward vertical integration, or a customer, upward vertical integration. Anecdotally, strategic buyers pay the most because of expected synergies. I've worked in corporate development for a publicly traded firm, and I can say without a doubt that the valuation process is much different than in private equity. However, I've also had talks with numerous business owners whose companies were active acquirers. In a conversation with one business owner, my valuation approach was castigated, almost to the point of getting chewed out by one of these serial acquirers because he said I was paying too much. He said he only pays up to some percentage, less than 100%, of the market value of the assets. I certainly have not transacted at that depressed level of valuation, but I'm offering it to show that a strategic buyer is not always the highest bidder. Another potentially nice aspect of selling to a strategic buyer is that the diligence process should be easier. They will probably be less concerned with your selling general and administrative expenses, SG&A, because they will look at your top line and factor in their own estimates for SG&A based on assumed synergies. One huge downside to selling to a strategic buyer is the risk involved with sharing information. Customer names, pricing strategy, employees, etc. are all very sensitive pieces of information, and the acquirer could benefit from having that info. Of course, you could put a non-disclosure agreement in place, preventing them from using any confidential information, but good luck proving they did it to your detriment. What kind of seller should be attracted to this buyer? The primary concern here is around confidentiality. If you feel comfortable sharing detailed information about your company with a competitor, this might be a good route. You might also choose a strategic buyer if getting the maximum amount for your business is your number one priority and you're less concerned about maintaining your culture, brand, etc. Additionally, most strategic buyers aren't concerned about whether you have engaged a sell-side advisor. That said, these relationships are hard to build. On top of that, there will be a limited number of potential buyers with or without a sell-side advisor. So even if this is your preferred buyer type, you should still consider other types of buyers before committing to anything. Financial buyers. Financial buyers are usually thought of as PE, though not all of them are. And within this class, there are active and passive investors. Active investors are more likely to spend time at the company and work with the management team, in addition to being active board members. Passive investors are just as the name suggests. Some are also thematic investors, targeting certain industries, types of sellers, for example, founder-owned businesses only, or geographies. Those that are not thematic might be called generalists. How do generalists compare with specialists? Is it better to work with a private equity group that specializes in your industry? Some sellers do prefer that. For better or for worse, we're generalists. Our philosophy is that there are certain fundamentals within any type of business. Executing on those fundamentals is critical. In very technical areas, we will bring in an operating partner to help navigate the nuances of a particular industry. But regardless, we think that there is potential in businesses of all types and prefer to maintain the flexibility to pursue whichever industry or segment we choose. Generally speaking, financial buyers come in a handful of different types too. Let me introduce you to the main ones. Family offices, traditional PEGs, small business investment companies, SBICs, independent sponsors, and search funds. Family offices. A family office is essentially a business in itself that has been set up to manage the finances and affairs of a very wealthy family. That would be a single family office, or multiple families, a multifamily office. It's often hard to research or find information on family offices because these families usually like to keep things private. That said, family offices can be a great source of capital, albeit a class that is hard to target directly. If you want to target this type of buyer, there are databases available for purchase and/or subscription. Most of the databases I know about, which are well regarded, cost at least $10,000 per year. On top of that, it will take a lot of time to contact these groups and begin a relationship. What kind of seller should be attracted to this buyer? It is hard to generalize here due to the wide variety of preferences and styles of the various families that have enough wealth to establish a family office. I think the primary areas of focus are understanding what the family office's objectives are with this deal on a wide variety of fronts, from their expected level of involvement in the business, who you will be working with post-close, how aggressive they will be towards growth, and many other areas. Everyone's experience is different, but my experience has been that family offices prefer to deal directly with business owners. This might be because they want to negotiate principal to principal. I have personally talked to folks that said, I don't talk to brokers, meaning investment bankers or business brokers. I don't personally like that mindset, I'm just passing it on. Another reason some family offices prefer direct deals is that they want to be the only one looking at the deal. They want to feel that it's a find. Now, I could understand if by find, I meant paying less than market, but that actually is not always the case. For sure, there are some folks that only want a bargain, but those folks seem to be in the minority. Because of this, it is helpful to discuss valuation early in the process. Traditional private equity groups, or PEGs, these are the firms and funds that most people typically think of when somebody mentions private equity or PE. They will likely have a fund with tens, if not hundreds of millions of dollars to use to acquire businesses such as yours. One nice aspect of working with a PEG is that they are relatively easy to research, both online and through your network. As with the challenge of picking a sell-side advisor, there can be a real challenge to pick the right private equity buyer. If you've engaged a sell-side advisor, this decision will be even more difficult because you won't have the luxury of getting to know the PEG over an extended period of time. Similar to family offices, PE buyers also prefer deals that aren't banked. Again, it is less about valuation and more about the allure of finding a unique deal. Regardless, the same suggestion applies here as with family offices. talk about valuation early. What kind of seller should be attracted to this buyer? In the lower middle market, most private equity buyers will strongly desire the seller to remain involved and financially vested in the business post-close. There are ways around this, such as removing yourself from the business, but that isn't always an option. On that same thread, if you feel like your company has the potential to grow and you need additional capital and/or other resources, a PE buyer could be just what you need. Additionally, selling to private equity will likely entail putting some debt on the business, albeit at a healthy level, so you need to be comfortable with that. Small Business Investment Companies, or SBICs. SBICs were created through the Small Business Investment Act enacted by Congress in 1858. SBICs are able to borrow up to $2 of government debt for each $1 of private capital they raise. The rate charged by the government is favorable, as you might imagine. There are some limitations as to what types of businesses SBICs can invest in, and there are certain upper limits on the size of the business. But generally, they are pretty flexible. SBICs typically participate only in lower middle market deals, though some might pursue SMB deals from time to time. The investment structure of SBICs is different from that of traditional private equity. Most, if not all, SBICs will invest debt alongside equity. Some are debt-focused and others are equity-focused. Debt-focused shops will typically not look to own a majority control, but might do what is called an equity co-invest, in which they invest alongside and on equal footing or pari passu with the lead equity investor. Other SBICs seek to own a majority and will provide all or most of the equity in addition to all or most of the debt. For this reason, sometimes SBICs are referred to as one-stop shops, meaning they can handle the entirety of the capital stack. Another distinction is that some SBICs do not have defined duration funds. Whereas most PE funds have a 10-year duration, some SBICs are open-ended, allowing them to stay in deals longer. This is definitely not the norm, though. What kind of seller should be attracted to this buyer? There isn't a huge deal of categorical difference between PEGs and SBICs in terms of which a buyer should prefer. It will probably come down to the people at the firm that you are working with most directly. There is also the potential to find an SBIC with a longer hold period. Independent sponsors. In a nutshell, independent sponsors are PEGs without a committed pool of capital. That might sound risky, but most independent sponsors have developed an extensive network of investors. Very often, traditional PE works with independent sponsors as a means to help drive deal flow. One of the most attractive aspects of working with an independent sponsor is that it usually results in you having an actual champion. While independent sponsors don't have the luxury of going deep into a lot of deals, once they find one they like, they fight hard to get it closed. What kind of seller should be attracted to this buyer? The biggest difference between other financial buyers and an independent sponsor is that the independent sponsor will likely be personally vested in the deal. PE firms and other financial buyers do a much larger number of deals typically, so there isn't the personal connection like there is with an independent sponsor. Regardless of whether you have a sell-side advisor or not, you will want to ask the independent sponsor about their sources of funds. Sometimes an independent sponsor will provide a support letter from another PEG. This isn't a bad thing, but it also isn't a great thing because that letter means little more than that the independent sponsor has shown the deal to the PEG and the PEG has enough interest to try to help the independent sponsor secure the deal. This is a judgment call, obviously. Another topic to discuss is who will be active in the deal post-close. Some PEGs that work with independent sponsors are very active in their deals post-close, perhaps even more active than the independent sponsor in some cases. Regarding the hiring of a sell-side advisor, I think the feedback is similar to that for other types of financial buyers we've described. It isn't a huge negative if the independent sponsor is really excited about your company, but it can be hard to get to know the independent sponsor in such a short time the process takes. Search funds. Search funds typically target SMBs, but sometimes work on lower middle market deals as well. The concept here is that the searcher buys a business with the intent of being the primary operator, i.e. president or CEO, post-close. This can be great if you would prefer to limit your involvement post-close. The downside is that searchers typically don't have such substantial relationships with their capital providers as do independent sponsors. What kind of seller should be attracted to this buyer? If your company is of a suitable size, selling to a search fund could be attractive because the expectation is that the searcher will be the CEO and treat the company and the employees like you did. Additionally, many searchers plan to buy only one business and run it for 10 to 20 years or even more. Financial buyers purchase based off EBITDA, and each has its own methods of performing this. Even if the methods are the same, some will almost always price within a narrow band, whereas others will vary pricing more. The various methods of valuing a business is a complex topic, but numerous sources on the internet do a suitable job of explaining it. One likely difference as compared to a strategic buyer is that the diligence process most likely will be much more intense. A financial buyer, to some degree, is backing you and your management team. In order to succeed, future cash flows need to grow. Of course, a strategic buyer wants the earnings of its acquisitions to grow, but there can be many other factors involved, such as access to a specific customer, technology, or even workforce. Another option is selling to an ESOP. These can be very effective. I will spare you the details, but if the company is wholly owned by the ESOP and the ESOP is taxed as an S corporation, the company will pay no federal income taxes. That would be amazing. There are others that are far more knowledgeable about this than I am, so I will just offer some comments that I have heard from actual business owners. 1. We looked into doing an ESOP and decided to go down that path. Unfortunately, I haven't been able to stay in touch with folks that decided to do this. What I can tell you though, is that I've heard from other folks that initially told me this, but then realized it wouldn't work for them and decided they did want to have a conversation with 4 Pillars about selling their business to us. 2. We looked into doing an ESOP, but we couldn't get the value we wanted and or the payouts were too far into the future and or too uncertain. In order to sell to an ESOP, the cash proceeds the current owner wants or needs have to come from somewhere. Oftentimes, a large portion is funded by debt. The remaining portion sometimes comes in the form of seller financing, or sometimes the seller just keeps the portion that is not paid with debt. Regardless, there is a very high likelihood that the cash proceeds at closing are significantly less if sold to an ESOP. 3. We're currently owned by an ESOP, but it's no longer working for us. There are many reasons why it might not be working for a particular company, but it is not at all uncommon for us to talk to folks in this position. An MPO is when the current managers of the company, and perhaps already minority owners themselves, buy a majority of the business. This can be a great outcome, but often with the same challenge as the ESOP. Other options. Although the vast majority of SMB M&A transactions and lower middle market private equity deals proceed through private channels, it's worth noting that there are other options out there. Initial public offering, IPO, or special purpose acquisition company, SPAC. For larger companies, an IPO or SPAC deal might be possible, but admittedly, at this size range, it is outside the area of my expertise. What I do know is that SPACs have recently lost their luster, or started to lose their luster at the very least. Dividend recap. If you're open to staying on as president or CEO post-close, a dividend recap might be a good option. A dividend recap is when outside capital is used to alter the ownership structure of the company and provide a dividend to the selling owner. This typically would be only for a minority position. SBICs are great options for this approach. PE can be a good option too. You just need to find a peg that does this type of transaction, as many are only able to participate in change of control transactions. Growth equity. Another option that works in some circumstances is a growth equity injection. This might allow the seller to take some chips off the table, but the primary objective is to inject capital into the business to pursue growth. The same comment applies though, as for a dividend recap regarding SBICs and PEGs. 1. The M&A market remains robust, but the conditions vary depending on whether you're selling an SMB or a larger enterprise. The exit options vary depending on scale as well, including both private and public pathways. 2. It's important to know your buyers. Are they strategic or financially motivated? Are they active or passive? How aggressively will they want to pursue growth? 3. Take some time to understand working capital and how it will be calculated. The universe of potential buyers for your business is very large, and it's oftentimes difficult to know which type of buyer to pursue, and within a category, which actual buyer is going to be best for your business. I might sound like a broken record here, but 4 Pillars is founded on the concept that relationships are the cornerstone for success. I can't overstate the importance that building a relationship with your potential buyer is the number-1 way that you can help influence a positive outcome. I'm not just talking about the deal getting closed. I'm talking about 3, 5, 10 years after you sell your business, you are still happy with the process. You're happy with what your business has become under the new owner. I'm Nick McLean with 4 Pillars. I hope you enjoyed watching this and gained some value from it. If you'd like to learn more, you can check out the ebook on this topic available at Amazon. Additionally, if you'd like to talk to me directly, there's a link to my calendar in the comment section below. Look forward to hearing from you, and please, as always, let me know if this video was worthwhile to you. Thanks for watching.